Hi, welcome to this video. Today we're going to be discussing two of the greatest financial minds in history. And in terms of studying these two people, you'll get a head start in your quest for consistent Forex profits. Yet hardly any Forex traders would ever consider looking at these two people. So who are they? They are John Maynard Keynes and Edwin Gould. Now, I'm sure most people watching this video have heard of Keynes. He developed one of the most influential economic theories ever. Okay, now he was an economist, and I'm sure regular viewers of my channel now have got a very dim view of economists. When you see them make projections into the future, they're normally always wrong. They can explain everything to you when they're on, say, Reuters and Bloomberg after it's happened. Keynes was an exception. Not only did he develop a fantastic theory of how markets move, he actually traded. And not many people know that, but he made a fortune. His track record is up there with top hedge fund managers. I just want to discuss how he achieved his success in a little bit of detail. And also Edwin Gould. Now, hardly anyone's ever heard of this guy. Most accurate market forecaster ever. He was frighteningly accurate about really big calls in the market, intermediate calls. He hardly ever got anything wrong. And what he put it down to, his success, I want to go through as well. Right, first of all, I want to start off with Keynes, okay? I just want to summarise his view of how markets move. And specifically, when you look at the storyboard, it's only about a minute or so long, look at his metaphor about the beauty contest, because that is what makes trading so difficult and why so many traders lose. But if you understand the metaphor of the beauty contest, you can get in the minority of winners. Right, here's the storyboard. I'm back in a moment to discuss. I'll go back after that, a short summary there of Keynes' theory on how and why markets move. Now, in terms of that theory, it'll never go out of date. And there's one famous billionaire trader who made a lot of money out of it, made it famous. Who was it? George Soros, and the theory of reflexivity. And if you look at the theory of reflexivity, he talks about a lot about how he uses feedback loops to make money. I just want to discuss feedback loops in a little bit more detail and how you can take advantage of them. And I also want to talk about how Keynes actually traded the markets, because he had a very simple strategy, to put it mildly. But before we discuss those points, what I want to do is just go through his track record. Okay, now I've said an economist making money. I haven't heard of any. Keynes is a one-off. Okay, not only did he come up with a theory about markets that won't go out of date, he actually made a lot of money out of his own theory. He started trading with £20,000. He borrowed 12,000 from friends and relatives, and he immediately lost it. Okay, then he got £20,000 advanced to him against his book royalties, paid back everyone he borrowed money off. He had 8,000 stake to start with. 20 years later, that initial stake was worth over £20 million. That's an incredible performance, up there with the best. Right, what I'll do is just go through a little bit more about getting or using feedback loops to your advantage, and also avoiding some key mistakes, and just go through the salient points of Keynes' strategy. We'll just do that on a quick storyboard again. So let's take a look at how Keynes made money. Right, let's look at predicting the beauty contest successfully, as Keynes puts it. Now, in terms of markets, they're complex, okay? A huge amount of inputs come into play to make what is a very simplistic looking chart to us when we look backwards, okay? It tends to lull beginners into a sense of security, which actually isn't there. Anything's easy looking backwards. And, again, I'll just stress this for beginners. You've got to understand the narrative fallacy. Economists, they will tell you exactly why prices moved after the event. It sounds like total common sense. Anyone could see it. But of course, after the event, when those economists try and predict forward, they get it frighteningly wrong most of the time. And I'd strongly advise anyone coming in the markets to go and look at the predictions of the major banks and brokers' research departments in terms of where currency pairs might go. Then look and see if their predictions come right. They very rarely do. Okay, and this is rather strange actually. Most big banks and brokers are too focused on the economic side, okay, and they don't pay enough attention to the psychological side. Okay, psychology is just so important, and in terms of understanding psychology in markets, feedback loops. Okay, I'm moving to extremes now. In terms of a feedback loop, markets affect psychology, psychology affects markets. So what you get is when prices rise, okay, investors become more confident, buy, then price rises more, investors become even more confident, and that loop continues, but eventually it'll move to an extreme. Now, that might sound, great. All we've got to do is work out when the feedback loop is going to break, okay, which obviously isn't easy, but I think George Soros makes a fantastic point about markets in terms of, obviously he's got Keynes thinking in mind. He says many events rarely happen as investors anticipate them. Okay, now looking out for anticipation of what investors think is going to happen when there is no basis in fact for the reasons that they've come to anticipate the event is a great way to spot a market turning point. I'll give you an example. Start of the year, I'm sure regular viewers know, we're just out and out bullish of the yen. Most people are bearish. And the reason we got so bullish was because the markets had anticipated something was going to happen with the yen, but there was no factual evidence that it would happen. And this was that the Bank of Japan would increase their monetary stimulus package. The Bank of Japan hadn't indicated it. Investors are anticipating that. If it happens, then it's probably in the price, but they're anticipating something with no factual backup. It's very important. So you can then look at a price chart and you can see, well, the yen is getting stronger. So it's probably a good time to buy. If you're wrong, you're not going to be wrong for a big amount. You have a relatively tide to stop. And you'll find this with markets all the time. When the fundamentals are at their most bullish, price action can indicate the turn, okay, or when prices are at their most bearish in terms of the yen. So it's a question of looking at the news and what traders are anticipating with no basis in fact, which I find really useful in catching turning points. And you can use the charts to see, if the price action has steadied up or is moving against the majority. Now, in terms of technical analysis and the markets, just to make a couple of points for new viewers to our videos, technical analysis is extremely useful, but it has limitations, okay? If you're a beginner coming in the markets, forget fancy patterns, Gartley patterns, etc. The price is supposed to move to pattern. It doesn't, okay? It's complete nonsense. Humans are very unpredictable, so forget patterns. It's not that easy. Also, if you're using technical analysis, always keep in mind all the known fundamentals are not reflected in the price, whereas one of the premises of technical analysis is that they are. They're not, okay? And in terms of this, why aren't they? Because let's say you've got a market, get a news event, is it instantly discounted? We do live in a world of instant communications. No, it's not, because investors can still buy after the news event has come out. If they're making money, for example, they might add to their positions. People who, perhaps want to get in on the action will come in and buy as well. So limitations for technical analysis. My own view is you should use technical analysis. We're great fans of it, okay? But work out sentiment and feedback loops, because they will warn you of a turn, and you can confirm that on the chart. Now, that's Keynes' simple method for success. And he actually refused to even call it a strategy. He just said, well, I'm a bit of a contrarian, really. He said he looked at the intrinsic value of a share. Okay, we do the same in currencies. And he just wants to look at, how much lower can it go? What are investors seeing? It's very similar to what we've discussed. And then he'd work out, well, actually, this probably isn't going to go much lower. Everyone else is bearish. I'll be bullish. I'll buy. Now, he said, I only buy a few careful investments. And by a few, he meant 2 or 3. Even when he had lots of money, got into the millions, he very rarely had more than that. I've said it numerous times. Diversification, waste of time, okay? Because you may as well focus on the best investments only. And Keynes made this point. He said, if you do diversify, you just end up getting nowhere. I've said that on numerous occasions and won't labour that point anymore. Now, and point number 2 is be a Leo Freeman saw hunter trader when buying. And Keynes was very much a hunter trader. So was a hunter trader. Well, Leo Freeman saw was a hedge fund manager. And he gave a few $100 million out to various big institutions and told them to manage the money. And he did a survey of how they made money. And there was one group that just basically cut their losses very quickly, got out the market if they were wrong. Now, if you're a contrary trader, being a hunter trader is a great way of trading. Now, what's sort of called the hunter traders, where they would come in the market, they'd always come in at bearish or bullish extremes, and they'd come in very small, okay? Then they would come in twice more if the position went against them to build up their full positions. They only needed a small recoil to get them back to profit. And they would try and hold. Now, it's not martingale because it was specific, 3 times only. Okay. And Keynes actually, he basically said he was really bad at market timing. And he didn't focus on it. He would just scale in. Now, if you're scaling in, you do it small. You don't do it big. Okay, it's a great way to do it because a lot of traders get discouraged. Because often when you try and do a turning point, come in with the full position, you get hit. Come with the full position, get hit. That's kind of psychologically hard. Predicting the exact turning point is difficult, or getting the best price. So scaling in small. Obviously, you've got to have a stop loss as well. A great way to do it. And the hunter traders that Leo Freeman refers to in his book, which is called The Art of Execution, they make tons of money. Okay, he called them hunters because he said they sort of got the share. This was shares again, one limb at a time until they got their prey. Okay, point number 3: hold longer term, stop in place. Now, in terms of Keynes, he would hold investments for years on end. I think a lot of traders don't like to trade long term. In terms of, obviously it's hard to be patient when you're making money. Okay, I'll give this example of the yen again. First 2 months of the year for us in the yen have been fantastic. You are so tempted to take in that profit. You think, oh, we're probably not going to go any further. It might recoil. But if you study markets historically, big trends last a long time. For us, the yen trend is really just getting in motion. So we've just got to have patience and hold longer term. And not, you don't need to have a big position when you're doing this either. Right. What do we got next? You can't understand complex markets. If in doubt, get out. Okay. And Keynes, despite the fact he's one of the greatest economic thinkers of all time, said, no one can predict human behaviour, and much of the time markets just don't make any sense at all. Okay, so if the market is not behaving in the way you think it should, this could be long term or short term, just get out. I'll give you an example actually here where I was trying to predict the beauty contest and I wasn't successful at doing it, and I thought my logic was fantastic. And this video is on the 3rd of March, okay, and last week I was saying in a video on Thursday that I felt the Euro USD was going down. Okay, I noted resistance on a chart, and I'm trying to anticipate what investors are going to do on Friday. There's 2 high impact events coming up in Eurozone, which could be very dangerous for the euro. Okay, Italian elections and Merkel trying to form a coalition. If either of those goes wrong, okay, the odds aren't high, then the euro will go down. Market very bullish of the euro. My logic is, how many of those big investors are going to pull out just in case? And I've assumed quite a few. So I've come in, I've sold, moves into profit, I'm getting happy, and then they all start buying against my position, or the market does. Now, that for me is just a warning. I do not understand why they would. Doesn't matter. You can't understand everything. I just clear out the position at break even, just leave my core trade in over the weekend. I still don't understand why people want to buy the euro into the weekend, but like I said, you can't understand everything about the markets, and you've got to do this, in my view. When you're looking at markets, never argue with the market. It might look, or it might appear it's doing something stupid. Well, I personally think it's doing something stupid, but that doesn't matter, does it? I'm best off to be out because I just don't understand what's going on. And too many traders actually will argue with the price. They'll say it shouldn't be where it is, I'll stick with it. That's just a dumb thing to do, in my view. If the price isn't doing what you expect, you get out. Okay. Now, in terms of what we've gone through here, it's all basic stuff, really. Nothing complicated. Obviously, the harder bit is obviously, doing it in the markets. But if you look at it with Keynes, one of the great economic thinkers of all time, his strategy is pure simplicity itself. He didn't trade often, and he made a bundle of money, which, like I said, for an economist, I just find that just so unusual. Right, now I want to go and talk about next trader, who is the guy called Edwin Gould. And yeah, he's got some great tips which we can use with these, to basically make money from the markets. Let's move on to Gould. We'll go back of that summary there of John Maynard Keynes and his simple investment strategy. Now, I did say something that might have sounded a little bit paradoxical to many people watching the video, which was terms of the euro. Didn't really understand the price action into the end of the week, but I left a small position on. That small position is at a much higher level. Okay, the big position was just put on in case, or what I thought would happen was the euro would go down into the end of the week as traders took positions out the markets because of the event coming up over the weekend. Of course, they were stupid in my view, but at the end of the day, the market is the market. I don't understand why the euro remained firm at the end of the week, so best to be out that big position, otherwise I get caught in the hole. Small position on a higher level, I can sleep easy. Right, now let's move on to Edwin Gould, what was a fantastic record of prediction and some tips on how he did it, and he makes reference to a book that changed his predictions from bad to good. The book is essential reading. If you haven't read it, you need to. Right, let's look at Edwin Gould in a little bit more detail. Again, we're going to go to a quick storyboard. Right, let's have a look at Edwin Gould and how he analysed the markets. He was basically active between the early 60s and the mid-80s. Now, just going to start with a quote from him. It says, "I carried out indices back over 100 years or more and soon discovered that no matter how much you knew about fundamentals, you still didn't get very accurate stock market answers." So he was trying to do it like a traditional economist and failing miserably. But he then changed the way he analysed the markets. And his track record was astounding in terms of his major calls and even in terms of minor calls. So I've got a few major calls here. There's a few others that are pretty good, but I've lost the book which they're in, okay? So these are the ones I can basically just remember, okay? In 1962, he said the Dow would rise by 400 points, but fall hard in early 1966. The Dow did rise by just over 400 points, and I think it was in February 1966 it fell hard. Okay, then in 1972 the Dow was at 940. He said it would hit 1,040 by year end. He made that prediction, I think, in March, so in early 72. It did hit 1,040. He was a couple of days out. It happened on the 2nd of January. 3 days later, he then said the bull market is over for the next 2 years. He advised everyone, he advised to sell within a few days. Prices started to fall, and basically the market fell by 500 points in 2 years, and then shortly after 2 years had ended, the market came back. Now this is his big one. In 1979, he predicted a super bull market. The Dow would hit 3,000 in 10 years' time. That was a wildly optimistic prediction at the time. No one expected a major bull market. 10 years and 2 months later, it hit 2,999.75. So he's at 2 months in 10 years. He was right to 0.25. Just amazing. And there were plenty of other big calls he did as well. Also he did numerous short-term calls. He hardly got any wrong. What was his secret? There isn't enough information on him, to work out exactly how he did it. But he obviously had an eye for the market. I mean, to say he worked hard would be an understatement. What he did do, though, was, with the fundamentals, he worked out you couldn't do it just with the fundamentals. So he developed his own sentiment tool, which was called the centimeter, right? And it worked out, how overvalued or undervalued shares were against the Dow Jones. So he could find peaks in sentiment. He used charts to time, obviously using long-term charts most of the time. And also he did a huge study of psychology as well. And he said actually that his track record turned around when he read The Crowd by Gustav Le Bon. And he learnt about how a crowd operates, submergence, then contagion, then suggestion, which helped him with his sentiment as well. Now, The Crowd, it's called A Study of the Popular Mind by Gustav Le Bon. I think it was written in 1895. To say it is a good book is an understatement. It is just one of those books that anyone should go and read. You'll find numerous traders who say that the book really helped them become successful. One I can think of off the top of my head is Ed Sakota. Read that book. It's just fantastic in terms of understanding the crowd. Okay, I was actually going to go into submergence, contagion, and suggestion in this video, but I've actually remembered I've done it in another video. So what I'm going to do is put the link to that video under this one. You can learn more about the crowd and the wisdom that is in it. If you're into stock investing, you want to know about the centimeter. It is actually in a book, if I recall correctly, called The Wall Street Waltz, and it's by Fisher. I can't remember his first name, but you'll find it in there. And Fisher actually tested it today, okay, and found it still very, very accurate. In terms of Gould, strange thing about him was he actually never traded, okay, despite how good he was with all these predictions. Now, in terms of what he said was, well, to be honest with you, it just keeps me objective. I quite analysing the markets, and he had a massive following. Okay, he had a newsletter. I think it grossed him about 50 million. So he was like just into it as a sort of challenge, not to make loads of money. I mean, 50 million. Yeah, I think most of us would be happy with that. But that was his philosophy. Also, I read one of his stock market letters a while back. They're fantastically written, really, really good. And he uses all this sort of witty prose and language. He doesn't call the 1979 just a super bull market. It's jet takeoff market and all this sort of stuff. Really good, really good. I know obviously we don't know exactly how he did it, but yeah, we've looked at Keynes earlier on. We know that Keynes, an economist into the fundamentals, sentiment. We know that Gould started out as a fundamentalist and he became more into sentiment, more into how investor behaviour operated, just like with Keynes. So both of them have got a lot in common. Now, a lot of people watching this video might say, well, it's all kind of simple sort of stuff. It is, but if it's good enough for these guys, we don't need to make things too complicated. Obviously, we've got to make it work in the real world, and we discuss how we try and do it in our videos. But being a sentiment trader, looking longer term, is a great way to make money. Anyone can master the art. Can't say how much money you're going to make doing it. We're all different, but we can all make money is basically what I'm trying to say. Now, in terms of the video, that is it for today. And the link to the wisdom of Gustav Le Bon's Crowd is beneath this video. If you haven't got that book, go and read it. It is absolutely superb. Thank you very much for watching me as usual. Take care and have a good day.